Hey there, everybody. It's Bob with Trade Genius. Got my good friend Phil here. We're running out of jobs and we're running out of savings. What could possibly go wrong? Stay tuned.
Trade Genius.
Okay, Phil, I'm exhausted. The last 2 days of the market is draining me. And then we get these reports and I don't see the silver lining yet. Care to explain?
Yeah, so today we had the JOLTS numbers, which is the job openings. And if we look at that chart, concerning thing here is that we're getting into levels we haven't seen since January 2021. And that's not really something that you would expect to see if, the economy is supposed to be growing. And I think part of the problem, Bob, people see like the GDP numbers that come out. First of all, they're government supplied. Second of all, the government is propping up GDP through debt creation, right? We're creating more debt than we ever have ever. No one seems to be interested at all in curbing the spending. And when you have, and I think that a lot of people don't understand that relationship between GDP and government debt. When you expand government debt, by default, it's going to increase GDP. So the scary thing about that is that if we do have any negative GDP number prints or declining GDP prints, then we're really cooked because not even all that government spending is saving the day. And that's, I think, what's going to be the other shoe that drops. And I think once the market and the algos get their heads wrapped around that scenario, I think that then we're truly in a bad news is bad news environment. Then on top of that, like you mentioned earlier in the intro, savings rate. This is significant, guys. All right. We had monster savings rate spike because of COVID. Why? Well, if you give everybody, if you essentially hand $2 trillion to businesses and people, savings rates are going to go up. And that's great for everything for a little while. But when it's basically a stimmy, it's exactly what you're going to see, a pop and a drop. Because no one can manage that kind of money influx typically, and it just goes away. And it's also just a short-term solution. This is why they say you can't print your way out of problems, because you need to have the engine producing. And the engine's not producing, the engine's contracting. And we're getting mixed signals because of expanding debt and things of that nature. But the engine has stalled. And this is most evident here in the savings rates, which now, guys, we're back to, the 2000s. And that's not what we should be seeing, right? We should be seeing a steady increase in this, and it's not happening. So there's a lot of issues. And I think, we talk about when this comes to a head. Bob, I know you're thinking like we're pretty much there. I say give it till Q1, but you and I both agree 2025 is when I think you have to look at the market paying the piper for all of this nonsense that we've been seeing for the last 3 years.
Yeah, well, interesting about the savings rate, Phil. That's an average. I would say 80% of the people have all the savings anyway.
Yeah.
So you got a lot of people with negative savings right now because they're in debt up to their eyeballs.
Yep.
And so, if you're upper middle class where you're already past the point of raising children, you still have money to spend, but everybody else is basically hand them out. The other interesting thing, Phil, is that the Fed's going to be lowering interest rates, and it's going to do absolutely nothing except lower the savings rate more, because we're going to be pushing on a string, and the government's going to find out really quickly here that you could spend as much money as you possibly want, except that when the government takes over more and more of the economy, it deadens velocity. And what I mean by velocity is the handover of cash, and you just end up still arguing into the ground. So there's going to be a comeuppance on this. Switching to today, though, was really interesting. I mean, I had an okay day, because Bitcoin decided to get off the selling bus. And, so we had a little bit of a divergence there. So I'm hopeful that Bitcoin kind of peaks around the corner, Phil. So maybe it's seeing that last hurrah before the Fed meeting bounce that we're getting. But the employment report on Friday, I don't know if it's going to be bad news is good news or bad news is bad news. Looking at this JOLT report, we get ADP tomorrow too, I believe, right? So
Yep.
We're going to get a little bit of a sneak peek, how basically the small thing about ADP and Paychex, like I was in this space, is that they aren't the unemployment report. They're just looking at basically 100 employees or less and what's happening there. So, a lot of times, that report isn't very accurate, but it gets telling in direction though. So we'll see if that's going to affect employment on Friday. I think we're going to have a big miss in employment. And so it all depends on how they want to fudge the numbers to give the Fed room. Somebody else, Phil, too, and I know I'm bouncing all over the place. Somebody else in the room pointed out that the 10-year is basically pricing in a 50-point rate cut. You have any thoughts on that? Hey everybody, it's Bob with Trade Genius. Usually I do fun ads that talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you have not joined our service yet, come check us out, tradelikeagenius.com. Full service. We have chat room, we have the algorithms for you, we give trades out every day, we educate you. So go to tradelikeagenius.com, check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
50 basis points would be a surprise to me. The way I look at rate cuts in the Fed is that they look at jobs and they look at the market. Even though they say they don't look at the market, they look at the market. And so I think jobs gives them a pass for 0.25. The market, I don't think we're there yet. Now, if we were to not get a bounce into the rate cut, and let's just say we just dove off a cliff here and, we're heading toward 5,000 on the SPX, which is about 500 points lower, then yeah, I could see something like, 50 basis points. So if we don't, but if we're kind of hovering around here, or maybe we're going up into the rate cut in a, buy the rumor, sell the news type move, and we still get a 50 basis point cut, it would be surprising to me. And then I would think, what is the Fed concerned with? To me, that tells me the Fed's really concerned, and that maybe this recession we're going to get, it's not a question of getting it, it's how deep does it go? Because to me, that's a pretty big rate cut for a market that's trading up, around 5,500 on the S&P 500. So maybe maybe they just see maybe the models they're not sharing with us on the jobs market is far worse. They already leaked out that they think the government's overstating the job situation. So maybe the data they're looking at, their models, is painting a far worse picture.
Yeah, and look, TLT guys, we told you the next shoe to drop for me is, and I don't want to get ahead of Bitcoin, is if we do get a Bitcoin move, which we're expecting, when that falters, then you want to get into SARK. With that, you want to be short but unleveraged if you can get away with it. And so there's very few things you can do. And there's these yield max trades, but they're still fairly new yet, to see how they operate in high vol environment. So far, so good. So they're going to probably be an opportunity for us too. And, and I'm very interested in energy. So we're going to have to figure out how do we play that in terms of being able to protect the downside, because, you showed me the chart of ExxonMobil, which is my biggest position, is that it doesn't like recessions. And so, other than hedging with puts or closing off positions, we have to look to see where the opportunities are to protect an oil move that can go all the way down, into the 30s or 40s if things get really bad. And we should talk about that later, because that can really change the geopolitical landscape too. Actually, bad news for oil price, good news for the world kind of a thing. So maybe we should talk about that on a slow news day, Phil. But other than that, guys, look, it's really getting interesting out there. I worry personally that we're going to be in an environment where there's going to be hope around the corner, but the prices keep falling. That's always been my big worry, kind of 2000, 2002 kind of a thing. We're always better off to get sharp sell-offs, because then you get sharp buybacks. But when they just decide to leave, you get an Alzheimer's market that is really painful, because you never know when you want to get short to protect yourself, because there's a pop around the corner that never really comes. So, I don't think we're there yet, but definitely it's getting me a little worried, because I think that might be the environment that we're going to see ourselves for sure in 2025, and we're just going to have to be max defensive.
Yep. Guys, let us know your thoughts on today's discussion. Post your comments below. As always, thanks for watching. If you guys want help navigating these markets, want to get into the room with us and check out the signals, check out our specials over at tradegenius.co. We have a number of different specials to fit your style of trading. Thanks, guys. Thank you, Bob. We'll see you guys on the next video. Take care.
Trade Genius.